I was wondering one thing about like rental property right now that I still owe, maybe $50,000-$60,000 on. Is it best right now, or is property going to continue to go up?
So would the question relate to whether or not you pay off the debt, whether you keep the property, or what would your ultimate objective be with the rental property?
If it was best to go ahead and get rid of it while everybody thinks everything's going up, and then purchase some more silver. This is basically it.
A couple of things there, Kevin. I mean, if I had no precious metals whatsoever, and that was an asset that represented a pretty big asset in my net worth picture, I think I'd rather have precious metals than real estate today. If you have precious metals already, then the question is, how does this factor in as an income component for you if it has positive cash flow? If that positive cash flow is, it's sort of my rule of thumb in terms of real estate, and this is personal. There'll be real estate guys out there who think I'm nuts, but I'm not willing to give up liquidity unless I can see something north of 10%. So if your return on the rental property is north of 10%, if I owned that property and the return was more than 10% a year, I'd keep it. If it's less than that, then the question is, you have something that can fluctuate in value, is not liquid. To the point that we made in this last question with Mervyn. You don't want everything in illiquid assets because it just means you have no tactical flexibility. You have to maintain some flexibility. But if it's just one part of your total net worth, then to me the question is, what's the rate of return? If it's better than 10%, if it was bought right, it might even be 12, 15, 18, I don't know. But if you're just barely making the payments, and it's barely, from a cash flow standpoint, barely positive, then you're probably better off having it in another asset to begin with, because I think it's axiomatic. Interest rates moving higher equals real estate values moving lower. And, as we talked about earlier, Bill Gross would say it, whether it's this year or 2 years from now, we'll see higher interest rates, and that implies lower real estate values. There's going to be exceptions to that on a location-by-location basis. The corner property, the riverfront property, the downtown location, there will always be exceptions, but I think in general, increasing interest rates are going to hurt you in terms of the value, and if it's only a nominal contribution in terms of paying for itself, move on to greener pastures. So only kind of where you bought it, what it produces in terms of income, but you could make that call. Those are my thoughts. Okay,
yeah, I think it's doing pretty good there. You mentioned something about junk silver there, the 50-cent pieces, maybe the silver dollars. The percentage is a lot higher. If I wanted to purchase some silver bars, it's better than picking up junk silver at this time?
Yeah, 100-ounce bars this morning were 65 cents over. 65 cents, what does that pencil out to be? Maybe 3%. You're still paying a premium for 100-ounce bars, but it's not 8%, and it's not 12%, it's not 16%. So that's where I would say, on something generic like silver, focus on the best price possible. I do like junk silver. Ordinarily, that would be my go-to because you do see these premium jumps, and it gives you the ability to arbitrage between bars and grow your ounces. And that's, as an existing client, that's something that we do for folks. Whether it's a bull market or bear market, you can continue to grow your ounces by playing that premium arbitrage. It's not something that usually lasts very long, and so ordinarily you would need to have that product sitting at a depository so you can liquidate it when the premium's there and buy it back when the premium dissipates. If you're coming to the market today, I'd say focus on hundreds, or just give up a call and see what happens to be the cheapest. Thousands are cheaper still. It just depends on whether or not you're going to store it. You don't want to take delivery of a 1,000-ounce silver bar. So what are your criteria, and we can match up the price with that.
Okay, would it be advantageous for me to trade a few bags of silver for bars, like 10 or 100-ounce bars?
you're looking again. If it's dimes, quarters, you can probably net about 8%. So if 8% free silver sounds good to you, then to me it's kind of a no-brainer.
Okay, and then half dollars and silver dollars. They're even better then.
They are, although we don't know how deep that market is. So there may be demand for halves of 100 bags before that premium begins to dissipate, or it may be 2 bags. Right now there's where the premiums are, and this is what we call price discovery. You bring product to market in a certain quantity, and then you figure out what the price willing to be paid is. Today the premium's 14 to 16% on your halves. You could drive that price down by bringing too much product to market. So
it'd only be a couple bags.
Yeah, it would certainly be worth looking at. It would certainly be worth looking at.
Okay, and then one quick one: could someone have shorted gold so much that, and then they bought gold, so they sold their gold and turned around and was able to collect on their shorts?
Sure. Yeah. I mean, that's
is that
the
what might have happened?
Yeah. If what you're suggesting is a Wall Street firm pressuring the price down just to buy the price back at a lower price, yeah, absolutely. Classic bear raid. I mean, if you look at the history of the Rothschilds, they had the best communication network, and the question was, who won the battle at Waterloo? Who won? Nobody knew. Well, guess who knew before anyone else knew? The Rothschilds knew. And they drove the price of gold down, and within hours bought it right back at lower prices because they created a panic out of gold, and it was absolutely fabricated. They had a knowledge advantage. They knew the outcome of the war before anyone in London did, and they went to London, created a gold panic, drove the price down, and lo and behold, that was, I mean, it was an absolute coup. So yeah, I mean, that's a reality. Would that have changed from the age of the Rothschilds to the age of the Goldman Sachses? I don't think so. I don't think so at all.
Okay, yeah, because that happened to me with the Hunt brothers too. I shot my silver up and I kept buying, and then it went straight down.
Yeah, no, and the Hunts sometimes get a bad rap for, the price of gold moving higher and higher and higher. Most of their silver was bought under $15 an ounce, and, there was a tremendous amount of movement into the silver market after that. But what created the collapse was not the Hunts, wanting to sell, but being forced to sell. There was a rule change. And literally federal agents marched into the Hunt brothers' trading operation and said, "You will liquidate. We don't care what the price is, and we don't care if you lose money. You're liquidating, and that's the only thing you can do. We're not accepting buy orders. You can only sell." So, I mean, the Hunts were destroyed by the administration, in large part because silver was getting to a price at that time which began to be, again, that tell of instability in the dollar, of real weakness in the dollar. And beyond that, the Hunts had this notion that they wanted to start a bank that was metals backed and would represent, I mean, keep in mind, this is a different era. I mean, there's a generation of kids that don't even know what the Cold War is. There was a generation that looked at the secession of Texas as a real possibility, looking at how bad our fiscal straits were in that sort of 70s, 80s period. And who was going to be the central bank of Texas other than the Hunt brothers? Well, I can tell you what, that doesn't go over well with the Fed. When you have monopoly status, anything that challenges the monopoly just doesn't go over well, not popular. So, yeah, I mean, they were forced to sell. A lot of investors lost on that basis. Good people didn't do anything wrong. Silver bugs, probably like me or you or somebody else, but on the wrong side of a change in rules, I think the nice thing about the metals market today versus then is that the U.S. market has become almost irrelevant And the rest of the world, in terms of volume, has become much more significant. So a change of rules here might hurt us, but it would probably be along the lines of an increase in taxes or something, which doesn't determine the course of the global market and doesn't change, buying habits in Shanghai or Hong Kong or Dubai or anywhere in India. So I mean, this is where we've progressed since then. The vulnerability that we had in the markets, where 70-80% of all volume was done in the United States. Now we're about a third of the market versus being 2/3. We really don't call the shots anymore. Asia calls the shots in terms of the direction of the metals market.
Right.
Thanks for your question, Kevin.
Oh, thank you very much, and thank you, David, for going the distance here.
Absolutely.
I'm really interested still in the subject of interest rates and how that relates to what's going to give us the conditions of a real honest-to-God bottom here. And so I'm wondering, what are you going to be watching and looking for in the conditions, factors for being able to tell when we're at a real bottom and we're heading back to the secular rise?
So relating to, you've got gold, the gold market, and whether or not the interest rates, those trends are somehow going to put us in a position where conditions are in place for gold to go higher.
Right. Today, just listening to the commentaries, I heard a couple people talking about how the interest rates. You see that there's a conventional wisdom that when interest rates are rising, that's bad for gold, and when they're down, it's good for gold. And I don't quite understand that. And but what I'd really like to know is what you're going to be watching. That's going to indicate to you when we are, when this has bottomed out.
Well, one thing for sure that's important, it's not so much interest rates that are important to the direction of the price of gold, it's real rates that are important to the direction of the gold price. By real rates, I mean what you get to keep after inflation and taxes.
Mm-hmm.
And to the degree that inflation is a variable and taxes are a variable, you kind of know what your hurdle is to get over.
Mm-hmm.
And so if interest rates move up 3 points, but you're still in negative territory because of inflation and taxes, a 3-point move, a 300 basis point move is not going to hurt the gold price at all. It's only when interest rates are clearly helping someone and giving them a reason to sell gold and be in something that's giving them a real positive rate of return that people would actually sell the asset and move on.
Uh-huh.
So I think one of the things that people are assuming is that inflation is benign, it's non-existent, it's not a worry, and so any increase in interest rates at all, because there's no inflation, will be gold negative. And you have to stop, scratch your head, and say, well, yeah, if you're the Fed, you're not thinking there's inflation. If you're the Bureau of Labor Statistics, you're not thinking there's inflation. If you're the Obama administration, if you're Republican or Democrat and just looking at the government statistics as they're produced, there's no inflation. And then you join the rest of the population of the United States who's paying bills and managing their checkbooks well, and you're saying there sure as heck is inflation. There's nothing that I buy that hasn't gone up in price over the last 12 months, 24 months, 36, 48 months. Everything is on the increase in terms of price. So that's what I think some of your commentators, Bloomberg, CNBC, and whatnot, they'll say, oh, this is very gold negative. Look, interest rates are backing up. They've gone from, as I mentioned, 1.66 to 2.5%. This is going to be gold negative. It's not the interest rates that matter. It's your real rate of return that matters, and people have to be compelled to move into paper out of gold because the value proposition just makes sense. You don't need the insurance anymore. You don't need to guarantee purchasing power preservation you're happy to own paper again. You're happy to own Treasury bills or whatever the question is. So the asset of the question is, real rates are more important.
Mm-hmm. Oh, that's good. And so, with this, it's the first I heard you mention today the $55 billion that they spent this week trying to hold on to that situation.
And they're losing.
So where does that? Well, you did mention where that puts the confidence in rotating back into paper. I'm also concerned about next year we're gonna start out with the Obamacare situation. I really have the feeling that combined with all the other weaknesses in the economy could very well push us right back into recessionary condition. And along with that, since people have just recently been burned, so many people, that's going to push people even more into a condition of fear and possible panic. What's your thought on that?
Sure. Obamacare may be the guarantor of the next recession. The only thing that may beat it to the punch is major problems in China today and major problems in the emerging markets. Being in a very interconnected world, the weakness in those geographies may spread our direction, where Obamacare is just the icing on the cake. But thanks for your questions, Thomas.
Okay, well, thank you once again. This has been such an excellent discussion. Thank you.
Glad you could join us.
All right.
Oh, yes. Hi, David. I wanted to thank you for the wonderful job you're doing and all the insights you're giving to us. And my question is, there was something I recently read by Andrew McGuire, and he's basically stated that there was approximately, 45 tons of paper gold that were sold just before the price went down. And this happened in Asian trading when the market was very thin and there were no buyers. And if the person was a legitimate seller, why wouldn't they wait until the England market opened or the American market when there would be more demand? And then this was followed by another update I read today that said that there was just a huge demand off the charts for the physical buying happening presently overseas, and that everybody is sellers and everybody is buyers and there's no sellers. So my question is, how much longer can this type of a situation go on of paper selling and there is actually so much physical buying that there's just a big discord between the two markets?
Thanks, Joe. Great question. I think, we're coming to a point where the paper markets, which if you're talking about futures, are anywhere from 50 to 100 times the size of the physical gold and silver market. So, when you're talking about futures contracts, this is where the vast majority of volume takes place. It dwarfs the size of the physical market, again, 50 to 100 times. But that market only operates on the basis of inventory that's sitting. Granted, there's not enough inventory sitting there to represent all of the trade that's taking place, but there still has to be some inventory that's there. Otherwise, COMEX is in a very dangerous place, and any of your metals exchanges are in a dangerous place if they don't have metals that they can deliver. What they're playing is a numbers game. How many people are going to call for delivery, and how many people are going to liquidate and settle the transaction in cash? The vast majority. And this is where if they're got an actuary or have a statistician running the numbers, the majority of time people settle in cash, and they don't need as much metals on hand as they are trading. But what is happening is, as you mentioned, Joe, is this massive shift in demand in the Asian regions. And I just got off the phone with my dad a couple hours ago. He's in Singapore. And he said the same thing that you did, Joe. And he's in touch with a dozen people there. Demand is off the charts. Physical demand is off the charts. And we are probably coming to the point, is it 6 months from now, 18 months from now, 36 months from now, COMEX is going to be very uncomfortable with the drawdowns in available metals for delivery. Ultimately, their credibility can be called into question if they have to, not because someone comes to them and chooses to settle a transaction in cash, but if they have to settle the transaction in cash because they don't have any metals. I don't know if you want to call that a default or not, but certainly there's a lot of reputational damage done, and being an exchange, looks a little bit more like a Ponzi scheme than an exchange where you assume that there's real stuff that can be, well, isn't that what it's called, an exchange, exchanged for. That I think is the problem immediately ahead is the credibility of COMEX. And frankly, if anyone's wondering where the pressure is going to come from as the battle intensifies between the paper and the physical market, it is going to come from COMEX. They've got their survival on the line. So does it come as any surprise to you that yesterday, in the midst of gold falling in price, that COMEX is raising margin requirements? They raise margin requirements again in the context of a price decline, not in the context of a price increase. That's when they should be requiring more skin in the game, is when prices are on the rise, requiring speculators to have a little bit more skin in the game. But here we are again, June 20th. CME Group increases margin requirements. This was a rise of 25% to $8,800 per 100-ounce contract. So there is an opposition here, and it is the folks that are defending an entrenched trade in paper gold, specifically the futures market. That is paper gold, and they've got a lot at stake. They've got their survival at stake. They've got their franchise at stake. If you don't think they're going to call in every favor possible to batter, to bludgeon the price of gold and silver, to eliminate the risk of this kind of a default scenario, then you don't appreciate who the opposition is. And I say opposition because you and I don't have anything at stake. Our reputation is not on the line. You buy a Kilo bar or you buy a Krugerrand, and maybe you've got to defend that to your wife or to your family members around the Thanksgiving dinner table. They may think you're a kook for owning gold, but that's the only thing that you've got at stake is justifying a position to your social class, to your family. These guys, they may not be in business, and they're fighting for that. They're fighting for that. So expect more of the same. It's one of the reasons why ultimately I'm not concerned, because the weakness that we've seen in the gold market has nothing to do with gold itself. It has nothing to do with gold itself. It has to do with the paper transactions which occur in the London Metals Exchange, the COMEX, where people are buying and selling leveraged contracts. The price has been hurt because of a trading of hands of futures contracts, long and short. Meanwhile, you continue to see the basics of the market, underneath the market, basic supply and demand of real available gold that's coming out of the ground, and ready buyers throughout Asia and the Middle East, and to some degree, small degree, the United States and Europe. That's the real market. That's the real market. So we can pretend that the price of gold is $1,300, but that's the price of gold as it relates to the futures market and where the price has gotten to on the basis of buying and selling paper contracts. If you want to see real supply and demand dynamics, I think this is where you ultimately see gold $3,000, $4,000, $5,000 an ounce.
Do you think there's any truth by some of these commentators on King World News that the J.P. Morgans and the Goldman Sachs have been initiating some of these huge paper sell-offs to protect the dollar and to validate quantitative easing?
I think you've got the President's Working Group on Financial Markets, and you do have some of your big boy bankers as a part of that group, and they will jump when the President says, they will say how high when the President says jump. But that's, I think as a larger theme, you don't have manipulation of the price. If that were the case, gold would still be $200 an ounce and silver would still be $5. If they wanted to manipulate the price, and if they were good at it, why didn't they win in 2002? Why didn't they win in 2003 and 4 and 5 and 6? They've lost. I mean, the best that they can do is respond to a call from the White House and, it says, hey, we need the dollar to look good. Okay, that's no problem. We'll take care of it. How long can they take care of it? I mean, we're talking about days, weeks, maybe months, but they're not dealing with an infinite amount of money until they are dealing with an infinite amount of money, in which case they destroy the dollar, and there's no strength left in what they're trying to do. If they wanted to manipulate the price of gold and silver into the ground and basically, get an extension of credit from the Federal Reserve where they could spend trillions of dollars to force the price of metals down, the only thing that would do is drive the price of gold and silver mad in the real market as a consequence of the debauchery of the currency itself. So it's not we're not looking at higher gold prices on the basis of a manipulation where they've lost control of a manipulated market. No, it's supply and demand, and it's investors like you and me with our thinking caps on saying, the Indians can't have a 9.4% rate of inflation without Indians in India buying gold as an antidote to bad monetary policy. You and I are always going to respond in a self-survival instinct to things that can hurt us. And if it's fiscal policy, if it's monetary policy, if it's fraud, if it's anything that we can anticipate, you can see built into our fabric as humans the desire to survive and thrive. And this is where I don't think anyone who thinks they can win in a price manipulation appreciates how powerful the human tendency or the desire to survive is. The market will do what the market will do. And that's, again, where I have great confidence in the price of gold and silver moving forward.
Well, I guess my last question for you, David, and thank you very much for that excellent comment. If someone like myself, in their metal portfolios is approximately 30% silver and 70% gold, with the ratio of silver to gold approximately 65-1, would this be an advantageous time to change some of that gold into silver?
To 50-50. If the tax consequences make sense for you. When they're not alike, you can't do a like-kind transaction because gold is not silver, silver is not gold. But if you sold some of your gold and bought silver, you could bring your percentage to a 50-50, and I think that would make all the sense in the world. Not because you like silver more. Ultimately, you're going to take that silver and buy more ounces of gold when the equation shifts to your favor. But I would do that. If you have ounces in a retirement account, that would be the best place to do it because then you have no tax consequences to work around. So that's the deal. You may improve your ounce position, but you'll do it much more effectively if you're in a tax deferred vehicle.
Thank you very much, David.